Good day, everyone. Trust you're doing well today. Today, we're talking about how the market performed last week. Just a few weeks ago, many investors were celebrating. The market was hitting new highs. Stocks were moving up, portfolios were growing. It looked like the good times would continue. But then again, something happened, Last week alone, the Nigerian stock market lost almost 8,800 points. The All Share Index dropped by 3.6%, closing around 235,941 points. Now, for some people, that number may not mean much, but think about it this way. Imagine you invested 100,000 naira into a basket of stocks that moved exactly with the market. A 3.6% drop means roughly 3,600 naira disappeared in just 1 week. That is enough to get people attention. So the big question is this: should investors be worried? Or is this simply a normal pullback before the market starts moving higher again? Now let's break it down. The first thing to understand is that markets do not move in a straight line. Even during strong bull markets, there are periods when prices pull back. In fact, after a long rally, many investors begin taking profit. Think about it. If you bought a stock right several months ago and it has gone up significantly, at some point you may decide to sell and lock in your gain. This is exactly what appears to be happening right now. Investors are taking money off the table after months of strong performance. But here's where things start to get interesting because not all market pullback are the same. Some are healthy, others are warnings. And the difference usually shows up in the details. One of the biggest warning signs last week came from the banking sector. Banking stocks have been some of the strongest performers in the Nigerian market. Names like GTCO, Zenith Bank, Access Holding, and other major banks have been leading the market higher for months. But last week, many of these banking stocks came under severe pressure. GTCO fell, Zenith Bank weakened, and when the banking sector starts struggling, the entire market often feels the impact. Why? Because banks carry a lot of weight in the Nigeria stock market. Think of them as the engine pulling a train. If the engine starts slowing down, the whole train slows down. That is why investors should pay close attention to what happens next, with banking stock. Because if these market leaders continue falling, it becomes harder for the broader market to recover quickly. But there's another piece to this puzzle that many people are missing. And this is where things become even more interesting because usually when investors panic, trading activity explodes. Everyone rushes to sell at the same time. Volume becomes very high. You see fear everywhere. But that is not exactly what happened last week. In fact, trading volume actually declined. The previous week saw at least 5 billion shares traded. Last week, that number dropped to around 3 billion shares. Now, why does this even matter? Because it tells us something important. The market may not be experiencing panic selling. Instead, it looks more like buyers are stepping back and waiting. There is a big difference between people desperately selling and people simply refusing to buy. And right now, it looks, like many investors are choosing to wait and see what happens next. That is one reason why this correction does not yet look like a full-blown market collapse. However, there's another signal that investors should not ignore: market breadth. This simply means looking at how many stocks are rising versus how many are falling. Last week, more stocks were falling than rising, and this is important because weakness was not limited to just one stock. The selling pressure spread across different parts of the market. When that happens, it tells us the correction is becoming broader. And broad corrections can sometimes last longer than people expect. Now, let's talk about the most important number investors should be watching right now: 230,000. Remember that number, do not forget it at all. Now, 230,000, why? Because that ASI level could determine what happens next. As long as the market stays above that area, this decline may simply be a normal correction after a strong rally. The market could stabilize, buyers could return, and prices could start moving higher again. But if the market breaks below 230,000 and selling volume suddenly increases, then the situation becomes more serious. That would suggest sellers are gaining control and it could open the door for a deeper decline. This is why many experienced investors are watching that level closely. It is actually becoming a key battleground between buyers and sellers. Now, let me ask you something. What could cause the market to recover from here? The answer is actually very simple. Buyers need to come back. But not just any buyers. We need strong buyers, institutional buyers. the kind of investors that move large amounts of money. One of the clearest signs that indicates that buyers are actually returning will be a strong increase in trading volume while prices are rising. In other words, if we suddenly see the market moving higher and trading activities picking up sharply, that will be a positive sign. It will tell us confidence is returning to the market, and confidence is one of the powerful forces in any market. Another thing investors should watch is the banking sector. If GTCO, Zenith Bank, and other major banking stocks stop falling and begin stabilizing, that could help the entire market find its footing. Remember, these stocks have been leading the market for a long time. If they recover, the broader market may follow. Now, let's look at the bigger picture because this is where many investors make mistakes. They focus only on what happened this week, but successful investors always zoom out. Yes, the market is under pressure right now. Yes, the short term trend has weakened, but the bigger picture has not completely changed. The market had a very strong run before this correction started, and corrections are a normal part of every bull market. In fact, healthy markets need corrections. Without them, prices become too stretched and eventually become vulnerable to larger crashes. Sometimes, the market needs to slow down so it can build strength for the next move. That is why not every decline should automatically create fear. The real question now is whether key support levels hold and whether buyers return. So where does this leave us today? Right now, the Nigerian stock market is clearly in a correction phase. No doubt about that. The short-term trend is weak. Banking stocks are under pressure. More stocks are falling than rising. And investors are becoming more cautious. But at the same time, we have not yet seen the kind of panic that usually signal a major market breakdown. Volume remains relatively subdued. The market is approaching an important support zone, right? And there is still a chance that buyers can step back in and reverse the trend. So the next few weeks could be very important. Will the market hold above 230,000? Will banking stocks find support? Will trading volume return? The answers to those questions may determine where the Nigerian stock market heads next. For now, smart investors are watching, waiting, and paying close attention. Because sometimes the most important market moves happen right after everyone thinks the excitement is over. And that's exactly why the next move in the Nigeria stock market is very important. Don't worry, I'll always keep you, updated. Now, if you're looking to get, regular stocks recommendation and stock market tips for both Nigeria and US stocks, I have a Telegram channel where I share frequent market insights to enable you beat the market. So if you're interested, indicate your interest by sending me a mail via the email in the description box of this video. If you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.